So, stocks,
Beautiful.
expected return.
Love them.
I'm a long-term investor. How do I calculate the expected return, Steve?
Okay. The first part is, let's say you can't sell the asset. I always like doing this because it's really good with ETFs, country indexes, but it's also the way, as we talked about in the last session, about discounted cash flow.
Yes.
Right? Because the base rate is, I shouldn't say base rate, the base understanding is, let's pretend you can never sell the property, or the stock, what would the yield be? So if I said Jacob gets 10%, you would go, okay, in 10 years he's bought that thing and then the rest of it's gravy. If I said 5%, you go, okay, 20 years to pay it off, right? If it's 20%, 5 years to pay it off, right? So that gives you the idea.
That's a good exercise. Yeah.
Okay, so there's theoretically no capital gain. So you calculate the base rate or the average long-term dividend yield, right, or the rental yield. Okay, same thing. So you say, okay, stocks I think is around 4% in the US, a little higher in Australia. Okay,
Right.
so that's your base figure. If I invest now and hold it for the long term, what should I get? Well, it depends on the price, but generally you want to be getting 5.
Yeah, if I
Right.
invest now, hold it till I drop dead.
Yep, you'll generally
get
probably
about
get 5, right? Okay, next part, calculate the expected capital growth over the long term. Same thing. Oh, this company's been growing at 3% per year. Okay, well, the dividend's 5. Okay, 5, 3, 8%. Okay. And then you'll knock off a bit for costs and inflation and stuff, right? Okay. You can do the same with property.